A year after a deep recession and in the midst of what we believe is truly a once-in-a-generation economic boom.
Welcome to this special budget edition of the Advisory Deck.
Day.
It is an exciting day. We're up here with Colonel Light and we're taking a look down at magnificent Adelaide Oval, where James and I have just been to a budget breakfast courtesy of the terrific people at EL&C Baillieu and Ord Minnett. James, how are you?
I'm cold actually. It looks like a nice view, but it's about 5 degrees I think this morning.
It is. We thought it would be too good an opportunity though to pass up to take a couple of minutes just to, I guess, pull a couple of things that we heard from Malcolm Wood, who's the Chief Economist at Ord Minnett, EL&C Baillieu, talking about the budget, talking about, I suppose, the position of Australia and South Australia, and talking about some of the opportunities for businesses. So, James, what's a key insight you pulled from the conversation this morning?
One, the budget's really dry, and this is someone like Malcolm who brings it to life, and I think you'll see that there's amazing amount of information in the budget, but you've got to have someone who understands it. I think that's that ability to bring, you know, if you're a company, it's your CFO who understands these things. For a budget, it's Malcolm. In the next 12-18 months, if you are in infrastructure, construction, aged care industries, consumer discretionary, what else is in there? The sort of health, good times ahead, big times ahead, low interest rates, a lot of government stimulus, a closed market, so money's being spent in Australia, we're not going overseas and spending money, so some really good times ahead there. I think where there are challenges remain in some of the areas like consumer staples. The wine industry didn't get a lot of love, and for South Australia especially, it seems like if you're in the wine industry, you probably are going to have to figure this out by yourself. And so there are certainly, to me it came away as a tale of almost two cities, that there are some sectors that are getting a lot of love, others that maybe are going, well, we're not too sure how to help you, so we're just going to have to figure that one out later on.
I think, you know, he talked about Australia and our economy in the global context, and while we sit here and look at our own individual circumstances and industries like wine and, you know, the challenge we've got with China in particular at the moment, he said, take this on the broader scale. Australia is so well positioned in so many ways for so many reasons, right?
Staggering, right? Like it really is. You think 12 months ago, it's sitting here in May, 12 months ago, we were in the end of the first lockdown across Australia. There were concerns about the stock market, concerns about property, spending on motor vehicles had fallen off, manufacturing had fallen off, and the speed of the response of the federal government and then state governments as well was amazing. And we are now in, look at the numbers, the best space we've been in for
planes are in
generation.
The sky.
Where people are flying again. I go back to the GFC 2007-8, and it took a long time to recover. And the numbers now are saying this recovery is that classic V-shape, very, very sudden and swift drop, but the bounce back has been just staggering. And if people aren't now, they haven't already positioned their businesses to recover and to start thinking about how they're going to drive their growth, how they're going to win customers, use technology, compete in what's going to be a new marketplace with a very different travel environment. If they haven't done that already, they better do it pretty quickly, because this economy looks like it's going to take off, and either you get on board and start spending and start investing and start getting hold of people and start engaging with your customers, or you're going to be stuck behind. It's not going to be a long, slow recovery where you can afford to sit back and wait. You're going to have to get on the front foot.
It's a really important point for any business leader to think about, that your competition is sitting there going, well, look, we didn't, you know, die in the fiscal cliff that we were supposedly going to go off when JobKeeper ended. We have actually done okay in terms of, you know, generating revenue, profitability, and we really now have the opportunity to invest in it. Right. We have survived. We've actually pocketed it. You know, we're doing okay on average, and of course there are individual
cases.
Household
spending is up, household debt is...
Savings are up, debt's down, all of these, you know,
people are ready to spend money.
They are, and so again, if you're not investing and building a plan to investing in your business, because of that competitive market that is going to move forward around you, now's the time, right?
let's hear what Malcolm has to say, but I think its message is we've got fairly good times ahead.
Absolutely. All right. Well, let's hear from Malcolm and get a couple of points that might be of value to you.
Exactly, and thank you very much for the opportunity to have a chat. Appreciate that. So you're absolutely right that we see the context for the budget as being one of a very strong global recovery. Equity markets are pointing to that. We think Australia is doing at least as well as any other advanced economy, probably better. And the budget at the margin adds to that very strong economic outlook. So that's sort of the key points that we were making in the presentation. Let me just justify those statements. First point on the context for the budget is equity markets have rebounded strongly from the COVID hits of last February, March. So the top right chart, the black bars show you that the hit in equity markets last February, March, the blue bars, the subsequent rallies, so much so on the bottom right, you've got equity markets in Asia up almost 50% from pre-COVID levels, US up over 20%. We've actually been one of the laggards along with Europe. We're at the back end of that around about pre-COVID levels. The contrast between the way equity markets are thinking about it and the way policymakers are thinking about it's quite clear in that chart on the bottom left with the G7 cash rate still locked in at zero. That's the blue line there. So that's the market context for the budget. The economic context is one of very much a recovery at the epicenter of this pandemic. So the way we've been thinking about the recovery is a four-factor framework. One is how well you're doing in managing the COVID, and on that score, the outlook's very optimistic in our view. So if you look at the top right chart, the green line on the right axis is the vaccine rollout in Israel. And that's been a leader globally among major economies. And so much so that Israel's level of new cases is now down to about 50 a day, down 99%, and the death rate's basically gone to zero. The lines beneath that on the left axis, the red and blue are the US and UK. They're well advanced in their vaccine programs. And as a consequence, on the bottom right chart of page 4, we've seen a big decline in new case levels there. And so we think that things will be getting closer to normal from the middle of the year there. Europe's the next group of lines in that same top right chart. It's lagging, and you can see the case level in the bottom left chart is still quite high. So we think Europe's probably 1 to 2 quarters behind the US, UK. But Asia's actually the laggard here, and we use Australia down the bottom right of that top right chart. Australia's actually no different to other countries in Asia who've managed the COVID problem very well. They've been a lot slower in rolling out the vaccine. So overall, we're saying this picture says that the countries worst affected by COVID rebounding, particularly from a market sense. So that's one positive for the recovery. A second one is the monetary stimulus, which has just been unprecedented in this cycle. The top right chart on this slide is the balance sheets of the big central banks. It's on the left axis. They've actually expanded their balance sheets by about $10 trillion, or more than 20% of GDP this cycle. That's extraordinary, more than 3.4 times the quantitative easing we saw in the GFC. And Australia's Reserve Bank's been the laggard among those major central banks, but if you look at the bottom right chart, we're actually picking up the pace of monetary stimulus, somewhat ironic when you consider the economy's recovering strongly. But there's a lot more liquidity to come into our economy over the next 5 months. So that's quite positive as well. The third factor that we put into the outlook is the fiscal stimulus. And here it's all about the US. The top right chart on this slide is the US budget position. And you can just see those deficits have gone off the charts. And President Biden talking about another 2 fiscal packages seems likely to continue that into next year. So what we've got here is for peacetime, an unprecedented fiscal stimulus. That's big enough to lift the global economy, let alone the US. And then the final factor in the boom outlook is how the economies are positioned. And here Australia's extraordinarily lucky. Our trading partners in Asia were the first to recover, so we're achieving near record surpluses. That's the top right chart. Commodity prices extremely good. Closed borders actually suit us because we spend more overseas normally than foreigners do here. And then you've got zero global rates helping Australia as a net debtor and the farm sector recovery. So you add all those factors together, and you end up with the outlook extraordinarily positive for Australia, also for the US, with Europe at the other end of the bus. So they're the reasons why we expect a boom, and the budget just added to that. And if I just take you through a couple of quick charts on the budget, and sort of touches on a couple of the points we've just made. One is the labour market's fully recovered. On the bottom left chart, employment's actually up almost 1% from pre-COVID levels, extraordinary performance. And the commodity price picture, which of course really helps the Treasury out as our commodity exporters earn big profits, that's gone extremely well as well. So the budget looks a lot better, and we think the forecasts for the forward year budgets are extraordinarily conservative. So the numbers there are likely to prove to be far better than expected as well. So if I show you the next slide, in the assumptions behind our budget are listed there in that table on the bottom left. And the key point we'd make out of that is they are just so ultra cautious. Employment is basically done that fiscal 21 recovery of 6.5% already as of March. So the outlook, we think, is dramatically better than those 1% per annum forecasts that the government's got in their budget. Similarly with wages, we expect that to rebound a lot faster than the government's expecting. And the iron ore forecast in the budget of $55 a tonne for next March, when it's already about 200, seems to us to be a little bit on the cautious side as well. So we think the outlook's a lot better. When it comes to where they actually spending the money, if you look at the page 10 here, it is spread around. There's more money for households with the extension of the low middle income tax offset, more money for the unemployed, people on benefits, and efforts to improve access to preschool and childcare. For business, there's big benefits from an extension of the instant asset write-off. That will be large, $25 billion over the forward estimates. Infrastructure, this happens every year, but there's a bit more in there for infrastructure. And then healthcare with the expansion of spending for aged care and the NDIS and mental health, that all will all benefit as well. But the key point for us here in the short term is this stimulus is actually back-end loaded. So in fiscal 22, the stimulus is just over 0.5% of GDP. So we've got an economy with a massive tailwind from all that stimulus that I mentioned a moment ago. This just adds to that, and to our mind really drives the boom. So they're the reasons why we think there'll be a boom.
I mean, it's a staggering situation when you think about it from this time 12 months ago.
Yes.
Really in the early stages of COVID, and so much uncertainty, both governments, business, private household levels, to now be 12 months in with low interest rates still, low inflation, stock market that's strong, property market, both commercial, residential, that's strong. You've really summarised what is an extraordinary set of figures. And then industries like infrastructure and health and a number of others that are getting a lot of money coming in from government as well.
Yes.
Is there an industry, and let's maybe note the wine industry that's certainly got its share of challenges.
Yes.
Is there an industry sector that you look at and think they've been left behind, they're not getting much attention from the government and they're going to struggle?
Yes. So the key industry I think that is facing trouble is the part of the tourism industry that relies on foreign inbound tourism, as well as outbound tourism by Australians. So, for example, I was talking to a business based in Cairns the other day, and the issue they're facing in North Queensland is that the foreign tourists, of course, are not there. And then for domestic tourists, so for example, people from, say, South Australia or New South Wales, we're all worried about going to North Queensland and getting stuck there. With some sort of instant, there's a case in Brisbane, so the border gets closed, or there's cases in Sydney and the border gets closed, whatever it is, right? So that seems to be holding them back. So if there was one sector that would be, to my mind, missing out, it would be that the part that's reliant on international tourists. And then, of course, there's businesses that really have benefited from Australians travelling abroad for many years. You think of the flight centres and Hello Worlds, who really benefit from those expensive trips we all book. Well, of course, none of those expensive trips are happening. Yeah. So that would probably be the two that you would think would be, most vulnerable. Then behind that, it's really some of the sectors that have been affected by structural change. So, here in Sydney, the CBD is looking healthier than it was 3-6 months ago, but it's not anything like it was pre-COVID. So I do think there's the work from home phenomena means that, demand for office space and related retail and CBD centres has shifted. Perhaps that's a change. We don't know if it's permanent, but let's say it's certainly going to last for a while. So you'd say those guys have also been affected. And then, bricks and mortar retailers who haven't got a competitive online product. Okay, people are feeling a little bit more willing to get out and go to the malls and the shops again, but to think that they're going to go completely back to the way they used to shop, line up in queues around Christmas and other important shopping seasons, I just think is stretching credibility now. So, they would be the industries that we would think are being left behind a bit here.
So Malcolm, even in those sectors that you are describing, these booms and opportunities and reasons for optimism where spending, should be high, I guess the circumstances of 2020 has shaken the decision-making confidence of a lot of business leaders, even in those sort of sectors. What are the kind of key risks that you think, I'm running a business in those sort of spaces. I am sharing some of that optimism you have, but I really need to be bearing these things in mind as I map out the next few years for our business.
Yeah, no, it's a great question. So the risks that we identify, and this is of course from a market perspective, on the upside, we think a key risk is that business will just be extraordinarily good this year and next. So a key risk for business is it misses out on that because it doesn't gear up for that opportunity. Let me just give you an example here. This is looking on page 11 at the household sector. So normally in a downturn, income falls. The black line on the bottom left chart, actually income didn't fall this time because the government basically provided an overcompensation to people who were losing their jobs. Now with a very strong jobs market, we expect income to continue to rise. You've got the tax cuts, 2% mortgage rates, which are driving, bottom right chart, a 35-year low interest burden. And the big one is the top right chart. So house prices, stock market, they've all recovered. So wealth, which is the black line on that chart, wealth, that's a wealth compared to income ratio. That is looking extremely healthy. It's at a record high. But people have saved all this money. That's the blue line on the right axis. It's an inverted curve, so inverted axis. So it looks a little confusing. So that spike down was when saving increased in the downturn. There's all this saving there. And then why do I need that saving for when my house price, my super fund portfolio, I've got a job, I don't have COVID. What do I need all that saving for? So we think this combination will drive inordinately good business. And I think that companies could struggle to find the labour they need to deliver for that strength of demand. So one risk is that you just miss out because you just can't get the labour to meet that demand. And I could go on, but we think that housing, business investment will also be very strong here as well. So that's the risk to the upside. One of the key downside risks would be if inflation comes back quickly in Australia. But whilst I could dwell on page 13, I think the important point to make here is that we think the inflation risk in the United States is much higher than here. So we'll actually get a bit of a lead indicator on this from what goes on in the United States. So I'm going to jump that slide and say, let's go to looking at the US. So of course, V recovery means very strong profits. That's slide 14. So when we think about the risks, one would be that central banks have to raise rates a lot sooner than they're hinting. The very strong economy, inflation does start to rise and interest rates rise. So people should be cognizant of that risk. And the key here, we think, is going to be what we call risk number 2, which is the US inflation picture. And we were highlighting this risk on Wednesday. And of course, the day after, there's a US inflation number, which is a lot worse than expected. I mean, it's quite extraordinary, right? But why we think inflation risks in the US are a lot higher than us is really captured by these 3 charts. The bottom left chart is money supply growth. And if you're old enough to remember monetarism and a guy called Milton Friedman, he used to show us charts like this. So Milton would be rolling over in his grave looking at this chart. US money supply growth is at 24% year on year. That's the blue line on that chart. Now, if that is a forward indicator of inflation, wow, that is a big risk, isn't it? So that's one thing there. Just by contrast, the same number in Australia is 9.8. So high, but nothing as extreme as US. Go to the top right chart, that's wage growth against unemployment. Now, the unemployment rate is on the right axis inverted again. So that means low unemployment is at the top of the page. So what we're seeing here is, unlike any other downturn in the last 30 years, this time round, US wage growth did not collapse. So they're starting this recovery with wages basically at as high as they got in the last recovery. So we do think that inflation will emerge in the US a lot sooner than in Australia. And of course, if I was to show you that updated chart for the inflation number that came out the other day, the blue line jumps to 3% in that bottom right. I mean, it's extraordinary. There's some one-offs to that, but we think that this is actually turned the corner and will rise. So that would be the key risk for business thinking about the outlook, is that inflation does emerge in the United States. They lift interest rates, and that has the ripple effect through the global economy. The other sort of risks we touch on here, we think the Aussie dollar's got upside risk. Of course, if the US raises interest rates a lot sooner than anybody else, that will help limit the upside in the Aussie dollar. And then the fourth risk is valuation in an equity market sense, which of course for a business guy is sort of less direct relevance. But we do see the US market as extended at this point in time. Valuation's a bit more reasonable here. So the key risks that we would be thinking about in summary would be the business is so good, we're not ready for it and we miss out on opportunities. And then on the downside, it would be an exogenous risk coming from the US with inflation emerging there sooner than elsewhere.
It's a great summary, isn't it? I mean, if you don't messages to business owners, board members, whoever it might be, if you're not gearing up to take advantage of what's going to come in the next 1 to 2 years, there's a good chance you'll miss out, because surprisingly, the economy is set up to really perform very well, which again,
correct. And after 22, I just don't think we should be making any guarantees here, because we'll have to see how the Americans handle what could be a tricky situation for them then.
Malcolm, you've been extraordinarily generous with your time, and you unpack these very complex graphs in a way that's really easy to engage with and come to. So thanks for both your optimism and unpacking this so clearly for our audience. Really appreciate it.
Let's go buy some shares.
Yeah, absolutely.
Thank
Thank
you.
you.
Thank you, gentlemen, for your time, and all the very best to you and your clients.
Fantastic stuff. Really insightful,
Yep.
useful stuff, James. A terrific way to spend budget morning, even if
Yep.
it's a little cold up here
Yep.
on Montefiore Hill. Colonel White's pointing at you, James. I'm not sure what he's indicating there, but
It's a feeling I'm out. I think.
he is. All right. Ladies and gentlemen, thank you very much for joining us for this special budget edition of The Advisory Deck.